Hello everyone, I'm Dr. Hisham Younis, your technical market analyst. Today I want to take you through my trading strategy in detail. It might seem complex at first, but essentially it's about identifying key zones in the market where trades are most effective. These key zones are areas where major players tend to make their moves, and understanding these zones is crucial to success in trading. So let's dive in and break it down step by step. Our main assumption is that big market players, market makers, investment funds, hedge funds always trade with clear strategic goals. They have the power to move markets to their advantage, which is crucial to understand. Our trading strategy taps into this insight. On our website, we highlight three key zones defining market behavior. The first and most important is the crowning regions, zones where market makers and major institutions aim to sell. These areas often act as major turning points, making them essential for our strategy. Or to buy. Typically, as our strategy clearly states, these particular zones are always marked by a distinct black line on the chart, which represents the target area specifically for market makers and large capital players, whether they are buying or selling. Within the space between these black lines, you will always find one zone designated for pulse movement and another zone that often provides some sideways trading action or consolidation. But ultimately, the essence of this strategy is to understand these zones as critical battlegrounds where significant buying or selling decisions are made, guiding the overall market flow and crucial trade entries. A key concept in this strategy is the exhaustion zone, which greatly impacts trading decisions. We created a special indicator to identify this zone. For example, if you bought gold around 2000 as a market maker or big institution, your target might be 3000 for profit taking. The exhaustion zone shows where many traders lose momentum and start to exit, signaling when the market is tiring. Some traders will buy from the same zones, but many will tire out or lose confidence along the way and won't make it all the way to 3000. These traders often abandon their positions around the 2100 to 2300 levels while you stay patient and continue onward. This exhaustion indicator is very helpful because it clearly signals the exact moment these traders exit, letting you know precisely when the market is giving up or losing strength. Essentially, it's a tool that reads the market's fatigue and helps you time your own moves better and more confidently. The core principle here is holding, retaining, and knowing when to let go thoughtfully. You fully own the asset and decide the precise moment to release it. When you do decide to release, you sell at your carefully planned target zone. Then, depending on how the market moves, your goal is to buy back the asset close to where you initially entered the market. However, the key is that you don't rush into buying again hastily. You wait for the right opportunity, ensuring your re-entry point is well considered. This strategy helps maintain disciplined trading and maximizes your potential gains while minimizing risks. You'll definitely see areas higher up in the market, but what you'll likely do is buy from spots that are closer or sometimes even lower than those highs. This strategy is fundamentally based on analyzing the relative weightings of various assets. Some assets carry higher risks, such as indices like the Nasdaq or the Dow Jones. When the relative weighting for these indices changes, we also observe corresponding shifts in the relative weighting of gold. Essentially, the strategy compares these relative weights against each other, operating on the key premise that, at the core, you're trading the US dollar, but in different forms or manifestations within the market. Is the US dollar is the US dollar is the main currency driving market movements, serving as the base currency for all markets. We adjust the relative weights of different assets against the dollar to better understand market trends. Our trading strategy centers on risk management, always setting stop losses at calculated levels based on ratios like 1 to 10, 1 to 20, or 1 to 30. This method has been tested through various market conditions and proven effective. If you look at the setup on screen, you'll see how this strategy helps minimize losses and maximize gains over time. This live condition clearly represents ongoing trades in the market right now. Dow Jones Index, I think, and others. It's currently trading at 42,496, right within those zones we've been discussing, the pulse and median zones, which allow for minor ups and downs naturally within the market. You'll notice the black marked areas on the chart. These represent market maker entry points, where they initially position themselves. The darkest zones we see are their actual target regions, where they plan to push the price toward. Market makers typically aim to move the price up to around 42,748 before considering selling and taking profits. This movement is part of their strategy to maximize gains while causing fluctuations within these specific zones. When traders buy, they patiently wait for a pullback near previous buying areas. Along the way, you'll notice many giving up, triggered by exhaustion or planned abandonment zones. Once these areas are abandoned, the market maker switches roles and pushes prices down swiftly from those earlier purchase points. Sellers join in, increasing downward pressure. This constant push and pull shapes the trading dynamics we're analyzing now. Traders often get exhausted, especially when working with indicators in sideways trading zones like those we see now. These zones tend to bring the market back to preferred buying levels, creating a repeating cycle. This strategy is based on holding positions, sometimes giving up, and watching the exhaustion indicator, which measures market performance over time to guide traders on their next move. A profit ratio of 1 to 10 and 1 to 20, which is the specified standard ratio that we use as a benchmark in this strategy. We can trade it within the range between the highlighted influence zones. For more, to understand this strategy more clearly and in greater depth, you can follow our detailed daily analyses that we publish regularly in multiple languages. Additionally, feel free to visit our official website where you will find comprehensive explanations dedicated to this strategy. Engage with us there, ask questions, and share your insights to deepen your understanding. Thank you for your listening and great follow-up. We always await you daily with new content and analyses of our special strategy. I am Dr. Hisham Younis, the technical analyst. Thank you.